What's going on, dividend chasers? It's the Dividend Bloodhound here with another investing episode. Today's episode we're going to talk about stocks to buy, the three best stocks to buy should President Trump win a second term in office next week. Now there's a lot of stocks that you could obviously buy. The whole market will probably benefit from the status quo continuing and the fact that he's a businessman and he's not purporting to put up taxes on capital gains gained from investing. So the market might react to that positively anyway across the market. But these are specific stocks that I would expect to do well under a Republican administration and a Trump administration in the White House. If that sounds like something that you'd be interested in, then do please stick around after the intro. If this video does bring you some value, it'd be absolutely fantastic if you could hit that big like button and subscribe to my channel as well, and even tick that notification bell if you're thinking, feeling, or both extra kind. That would be absolutely fantastic. See you on the other side. Hey again guys, welcome into the video. So as we were discussing, which are the best stocks to buy should Donald Trump, the current US president, win a second term in office. Now, Republican administrations and Trump has proved already that they look favourably on big business and also like the big oil companies, defence sector stocks, banking sectors, that side of things, because that's just the way Donald Trump and his administration is geared at the moment. Just as a Biden administration would be kinder to green energy, most analysts and most investors expect a Trump administration to be kinder to the big oil industries. And I know that oil companies have taken an absolute walloping so far due to the global pandemic, cruise ships being tied up alongside and airplanes not in the sky as much as they should be. But under normal circumstances, and we do expect to return to that at some point, a Trump administration will look favourably because they're not as hot on the global warming topic as perhaps some would argue they should be. This isn't a political discussion. They're just not as much as the Democrats and Biden would be, for example. Now then, our first stock is perhaps the biggest of big oil over in the United States, and that is Exxon Mobil. This company is a huge oil provider, not only to the United States, but the world, but it is not immune to the thing that has strangled essentially all oil companies across the world at the moment, which is the global pandemic. I'm not going to go any further into that because that is now more than obvious. The company is down 52% year to date. A share will cost you approximately $32, and the dividend yield is starting to creep pretty high now, so some investors, it will ring alarm bells because it's double digits at 10.4%. So a lot of investors are getting a little bit itchy feet about it because obviously the higher the dividend yield gets, the more of a worry it is for us investors with how sustainable it actually is, especially with oil prices being so low at the moment. The dividend is just about covered. They have enough revenue and reserves to pay it 1.1 times over in terms of free cash flow. And they have 38 years of consecutive dividend growth behind them. So they have a fantastic history, but they've never had to deal with anything like this. 10-year compound annual growth rate is 7.5%. And unlike all the other oil and energy majors, such as BP and Shell, Exxon has not cut its dividend yet. Shell ripped the band-aid off pretty early, and then BP followed suit just a short time afterwards. They both cut theirs by 66% and 50% respectively. Exxon has resisted the temptation to do that at the moment, but who knows what the future will hold. But a Trump administration will be the better prospect for Exxon going forward. Let's get into the app and let's have a look at exactly how Exxon's fundamentals stack up at the moment. See you in there. Hey again guys, welcome into the app. So here we have the calamity that is Exxon Mobil's share price at the moment, ticker XOM, down 53% year to date. In the last year, should I say, it recovered to $54 a share in June, but has since plummeted back to where it started, peak pandemic, almost exactly the same price actually. So it still has a market cap, even at the price that it's at, of $144 billion, a PE ratio of 13.21, revenue of 255 billion, EPS of 2.59, and a dividend yield at 10.19%. So that is a fantastic return on your investments, but a lot of investors will start to see it as getting a little bit precarious and not as sustainable as perhaps it ought to be. So they have a net income of 14.34 billion, a profit margin originally pre-pandemic at 5.61%, a debt to assets ratio of 47%, which is particularly low actually. And then if we hop on over to their growth metrics, we can see that 3 and 5 year revenue growth, 3 year is in decline. That's quite obvious reasons for that at the moment, but over 5 years it's actually grown at 8%. EPS is down over the 3 years but up over the 5 years. 5 year compound annual growth rate is down 12% as well, and the 3 year dividend growth rate is 4.8%, which isn't bad, but it could be better. But that yield is absolutely enormous, and it does have the 38 years of consecutive growth behind it as well. Going to wrap things up there, and I'll see you back in the real world. Welcome back to the real world, guys. So that was Exxon Mobil there. Energy, oil, massively out of favour with investors at the moment for obvious reasons. Profits and revenue have taken an absolute hammering due to the pandemic, and there is also that green energy revolution hovering in the background somewhere that means that oil majors are going to have to take action in the near future. Moving on to our next company then. Our next company is Twitter. And the simple reason for this, as social media as well, is Donald Trump loves to leverage social media to get his message out to the world and get his message out to people. Love him, hate him, he's an absolute expert at taking headlines with his social media accounts. And inherently, those people, whether they're massively on board with him with the red caps, make America great again, etc., or they absolutely loathe him, both of these groups of people can be advertised to by social media accounts, social media companies such as Twitter. You can advertise to them, you can monetize them, and with his tweets getting millions and millions and millions of views and retweets, etc., etc., that is a powerful thing that only Donald Trump does. I can't see a President Biden doing or making just as many tweets as Donald Trump does. Twitter is obviously more of a growth company than it is a dividend company. It doesn't actually pay a dividend, so there's no dividend growth metrics or yield to purport. It is just all about the growth with this company and all about buying low and selling high, essentially. And a Trump victory could certainly see a spike in the share price. Twitter is currently up 52% year to date, so it is already doing particularly well for itself, but I would expect this to continue as a lot of investors see this tech sectors, especially in the global pandemic, to be a safe and more robust sector to keep their money, sort of like gold used to and still is. People are viewing tech sectors as very robust to the economic climate that's going on at the moment, perhaps dangerously so, some people might argue. Let's get into the app and let's have a look at the fundamentals of Twitter. I'll see you in there. Welcome into the app, guys. So here we can see the share price is actually $48.75 at the moment. There has been a slight sell-off today, down from the £51 that it was due to the market sell-off that has occurred today. It is still at almost record highs, to be fair. If you managed to buy in peak pandemic when nobody knew what was going on, you could have picked up a share for $24, and that's clearly doubled your money at the moment, which is pretty good. So it has a market cap of 39 billion, a PE ratio of 27. That is creeping up, but nothing to be worried about too much. Revenue of 3.46 billion, an EPS of $1.87. Has a net income of 1.47 billion and a profit margin of 42%, which is remarkably high. Debt to assets is pretty low at 31%. That is a good thing. The lower the debt, the better. And then if we hop on over to the growth metrics here, which is what this company is all about, we can see 3 and 5 year revenue growth at as near as makes no difference, 20% and 11%. A compound annual growth rate not quite available yet, and obviously there's no dividend growth to report either, because that's not how Twitter does its business for the moment. So that is Twitter there, guys. I will see you back in the real world. See you there. Hey again, guys, welcome back to the real world. That was Twitter there then. As we know, Donald Trump loves a good tweet, so 4 more years of tweeting will continue to get Twitter's stock price absolutely flying. Moving on to our next stock, that is in the defence sector, because defence stocks and defence companies tend to do a little bit better under a Republican administration, according to some investing analysts. Now, the stock we're going to talk about today is Lockheed Martin. This company is and has the world's most expensive weapons program, a absolute solid form of revenue out for decades and decades to come, and that is with the F-35 program, the 5th generation advanced stealth fighter jet. The program is worth $484 billion through to 2044. And $1,196 billion through the whole service life of the aircraft to an initial point at the moment at 2077. However, that could go on for a lot longer based on how advanced this aircraft is. Now, if you've got a long-term horizon with your investing to 2077, this is the company for you, because this company is going to be scooping in billions and billions of dollars for the next 57 years. That is absolutely sensational. Not only that, that is not the only sector Lockheed Martin actually works in. It works in rotary wing, aeronauticals, fire control and missile systems, and also space. It has its own rocket program and is currently in a collab with Boeing to help launch US military satellites into space, along with obviously SpaceX, but these are companies that you can actually invest in because SpaceX is of course privately owned at the moment. It's currently down 5% year to date, and the approximate share price is around $350 and around a 2.5% dividend yield. It has 18 years of consecutive dividend growth and a 10-year compound annual growth rate of 14.42%, and that is just getting started really, based on what I've just said with the F-35 program. That all being said, let's actually get into the app and let's have a look at Lockheed Martin. I think you'll be pleasantly surprised. Let's get in there. Hey again, guys, welcome into the app. Here we have Lockheed Martin, ticker LMT. Current share price $354 a share. Dropped to 278 peak crisis, and then has been a little bit up and down since, up to 414, and then down again to 340, and then we're back at the moment. It's dropped off in the last couple of days, last couple of weeks should I say, down to 354. Has a market cap of $103 billion. A PE ratio of 16.99, revenue of $60 billion, just shy of, earnings per share of $21.69, and a dividend yield, as mentioned, of 2.82%. Net income is $6.23 billion and a profit margin of 11.42. A high debt to assets ratio of 93, not over the 100% margin, but certainly getting close there. That is a little red flag for me. If we hop on over to the growth metrics, I must say actually it's not unusual for a defence sector company to have a high debt level, because they have to stay ahead of the curve. And if we have a look at 3 and 5 year revenue growth respectively, both at 8%, that is good. Earnings per share growth at 3 and 5 year, 16 and 22%, double digit growth, that's great. 5 year compound annual growth rate is 11% and just shy of double digits, 9.9% 3 year dividend growth, which is pretty good too. I'm very happy with this company, and you should be too if you get involved and invest with this one. I'll catch you back in the outside world. Welcome back to the real world, guys. Thank you so much for watching those 3 stocks there. I do make sure that you check out my video that's got the 3 best stocks to buy if Joe Biden and we have a Democrat administration in the White House. And then there's also 3 stocks out there that it doesn't matter who's president, they should all do well as well. The last thing I'm going to say is there tends to be a little bit of market volatility around presidential elections. That has been seen on the day of recording this video. There's been a sharp decline in the markets today, and that brings the decrease in days to 3 in a row now as we run up to the election. There is volatility there for especially dividend investors and long-term investors to take advantage of. If you're going to be holding for the next 10-20 years, you're not so fussed about what the price is doing at the moment. If it does dip, it's a great bargain to be had. There isn't long left to go now. I'm holding a small cash position so I can deploy that if there is any significant opportunities that present themselves, and then I might add some more cash if it becomes available after payday to also take advantage of any opportunities. Hope you've enjoyed the video, guys. Do please smash that like button if you haven't already, and consider subscribing to my channel. Hopefully I'll see you in the next investing episode. Catch you there.